Within less than 48 hours, three European countries did something extremely unusual. Denmark announced a complete exit from U.S. Treasury bonds. Not a reduction, not a rebalancing, a full withdrawal. Shortly after, Sweden confirmed that it had quietly sold nearly $9 billion worth of U.S. government bonds. No press conference, no market warning, just selling and silence. And then came Germany. A country holding the second-largest gold reserves in the world began publicly discussing the repatriation of its national gold from vaults in the United States. At present, roughly 236 tons of German gold, equivalent to more than 37% of its total national reserves, valued at approximately 113 billion euros, are still stored in Manhattan inside the gold vaults of the Federal Reserve Bank of New York. Three actions, three different countries, all occurring within the same week. Viewed individually, these could be dismissed as technical decisions. But placed side by side, the picture begins to change. Because these are not hedge funds, not short-term traders, not hot money. These are national pension funds, sovereign gold reserves, assets designed to never be allowed to panic. Capital like this does not react to headlines. It does not chase yield. It does not move because of short-term volatility. It moves only when something deeper changes, when the underlying risk model shifts. And that is the part that forces markets to pause. Because if the most patient, slow-moving, and conservative institutions in the financial world begin preparing for withdrawal, then the question is no longer how much money has been sold. The question becomes, what are they seeing that the rest of the world has not yet noticed? Financial markets rarely signal change with a loud explosion. They do not shout. They do not issue public warnings. Most of the time, they whisper. And when those whispers appear simultaneously in multiple places, quietly, discreetly, among actors who almost never move quickly, history suggests that a major shift has often already begun, long before the crowd becomes aware. And don't forget to subscribe to the channel before we move into the detailed analysis of these events. At first glance, what just happened may look like familiar financial news. A fund selling bonds, a country adjusting reserves, a politician making a statement. Markets have seen such things hundreds of times before. But this time is different. Because these decisions did not come from the usual sources of volatility. They did not originate on Wall Street. They did not come from investment banks. They did not come from cyclical traders. They came from institutions designed to never be allowed to act quickly. National pension funds exist for one purpose: preserving value across decades. They are not allowed to be wrong for a single year, because the cost of error lasts an entire generation. Sovereign gold reserves are even slower. Gold does not yield interest. It does not generate cash flow. It is not meant to be traded. It exists for one reason only: trust. So when a country begins questioning where its gold is stored, that is not a financial decision. It is a decision tied to survival. And that is precisely what makes this week's chain of events dangerous. Because none of these actors are trying to earn higher returns. No one is saying U.S. Treasury yields are too low. No one is claiming to have found better investment opportunities elsewhere. They are saying only one thing: that risk has changed. This is the point most viewers miss. Markets do not collapse when yields rise. They do not collapse when stock prices fall. They begin to fracture when assets once considered risk-free start to be viewed as risky. That moment is never loud. There are no alarms, no sensational headlines, only quiet decisions made behind closed doors by people famous for their caution. And when such people begin adjusting their behavior at the same time, the market is telling us something very clearly. Something deep within the global financial system is changing, even if most of the world has not noticed yet. Words can be interpreted, statements can be revised, press releases can be rewritten, but money cannot. Money has only two actions: stay or leave. And if you look at the official data from the U.S. Treasury, something very strange is beginning to appear. Small Blue Diamond, according to the Treasury International Capital, TIC, report the total amount of U.S. Treasury securities held by foreign investors has been declining continuously since 2022, falling from a peak of over $7.7 trillion to lower levels, despite sharply rising yields over the same period. Over the past 3 years, foreign holdings of U.S. Treasuries have not increased. They have steadily declined. That may sound normal until you look at the context. During that same period, U.S. Treasury yields surged from near zero to over 4%. According to traditional financial logic, this should have acted as a powerful magnet for global capital. Higher yields, deep liquidity, the largest bond market in the world. But capital did not do what it was expected to do. It did not flow in. It stood still. And then it began to flow out. Japan, the largest foreign creditor of the United States, has been steadily reducing its holdings. Small Blue Diamond between 2022 and 2024 alone, Japan's U.S. Treasury holdings fell by hundreds of billions of dollars, alongside a renewed rise in Japanese domestic bond yields after years of yield control. China has cut its U.S. Treasury holdings by nearly half from peak levels. Small Blue Diamond from more than $1.3 trillion in 2013, China's holdings have now fallen below $800 billion, and the downward trend continues. And Europe, once considered the most loyal bloc, is now beginning to waver. This is not panic-driven capital flight. If it were panic, you would see abrupt sell-offs. You would see violent volatility. You would see emergency headlines. But none of that is happening. Instead, you see numbers drifting lower slowly, month after month. That is the sign of something far more dangerous. It is a deliberate withdrawal. When large institutions sell assets because yields are too low, they usually return when yields rise. But this time is different. Yields have risen, and they have not come back. That tells us something very clearly. The problem is not the level of interest rates. The problem is something yields cannot compensate for. Risk, not economic risk, not recession risk, but political risk. When an asset begins to be labeled political risk, its entire valuation framework changes. No level of yield is high enough to erase uncertainty. And this is the moment when the market enters an entirely different phase. It is no longer a story about returns. It becomes a story about where trust still exists for long-term asset storage. When capital begins asking that question, major shifts rarely happen in noise. They happen in silence. And by the time they appear in headlines, most of the process is already complete. To understand why what is happening today is so concerning, we need to go far back in time, to the period after World War II, when much of Europe lay in ruins and the global financial infrastructure was nearly destroyed. The United States was the only economy left standing with intact productive capacity. Out of that context, a new order emerged. The Bretton Woods system was established, placing the U.S. dollar at the center of global finance, directly pegged to gold. Other nations pegged their currencies to the dollar, not because the dollar was perfect, but because there was no better alternative. The United States held most of the world's gold, possessed the strongest military, and most importantly, had the ability to maintain order. For decades afterward, storing gold in New York was not merely a financial decision. It was a political statement that the United States would serve as the custodian of the world's assets. And the world believed the United States would not abuse that role. Even after the Cold War ended, this habit continued. Germany kept its gold in the U.S., Italy kept its gold in the U.S., the Netherlands, Austria, and many others did the same. Not because they lacked storage facilities, but because of trust. By the same logic, U.S. Treasury bonds became the asset considered risk-free. Not because the United States could never default, but because it was believed the U.S. would always honor its commitments. Even amid internal chaos, even amid political division, the market believed one thing: the rules would not change abruptly. For more than half a century, that belief allowed the United States to borrow at lower costs than any other country in the world. That was not an economic advantage. It was the privilege of trust. And that is why, when countries today begin questioning where their gold is stored or the safety of U.S. treasuries, what they are doubting is not the strength of the U.S. economy. They are doubting something far more important. They are questioning whether the old rules, built in the aftermath of World War II, are still truly inviolable. Trust in finance does not disappear overnight. It does not collapse because of one bad data point. It does not shatter because of a recession, and it rarely vanishes simply because public debt rises. Trust changes direction when the rules change. For decades, the world accepted an unspoken assumption. The United States could be internally chaotic, but it would never turn the financial system into a political weapon. Money was neutral. Reserve assets were untouchable. Access to the global payment system could not be revoked simply because of political disagreement. But then that began to change. When financial sanctions expanded, when the assets of entire nations were frozen by administrative decisions alone, the world realized something fundamental. Assets were no longer just assets. They could become leverage. That moment did not create immediate volatility. Markets continued functioning. The dollar remained strong. But at a deeper level, a question began forming in the minds of national asset managers. If this could happen to them, could it happen to us tomorrow? And once that question appears, it never fully disappears. From that point on, the concept of an absolutely safe asset began to fracture. Not because the United States lost economic strength, but because a new risk emerged, one that cannot be modeled financially. Political risk. You can calculate interest rates. You can hedge inflation. You can insure against credit risk. But you cannot hedge against a political decision made overnight. And that is precisely why central banks began acting differently. Not through panic selling, not through sudden capital flight, but through behavioral adjustment, increasing gold accumulation, reducing dependence on a single system, seeking to diversify where assets are stored, not because they believe a crisis will occur tomorrow, but because they understand a core principle of risk management. When a risk once assumed to be non-existent begins to appear, assuming it will not happen again becomes the most dangerous mistake of all. The moment trust shifts is not loud. There are no headlines, no alarm bells, only quiet decisions. And when enough quiet decisions accumulate, the financial system enters an entirely new phase, even while most of the world has not yet realized that the transition has already occurred. When foreign capital begins to retreat from U.S. Treasury bonds, a very practical question immediately arises. Who will buy that debt? The United States cannot stop borrowing. The budget runs multi-trillion-dollar deficits every year. New Treasury issuance must continue, not to invest, but to refinance maturing debt. Small blue diamond in the most recent fiscal year alone, the U.S. Treasury issued over $7 trillion in new debt, most of it simply to roll over existing obligations and fund deficits. For decades, the largest buyers were foreign holders: Japan, China, Europe. But when those buyers begin to hesitate, the burden must shift elsewhere. First, to commercial banks and the primary dealer system. These are institutions obligated to purchase Treasury securities at auction, whether they want to or not. When natural demand weakens, primary dealers are forced to absorb more Treasuries than normal. Small blue diamond, according to Federal Reserve Bank of New York data, Treasury inventories on primary dealers' balance sheets have risen noticeably during weak auction periods, a sign that secondary markets are absorbing supply more slowly than before. And when they absorb too much, risk does not disappear. It merely changes location. Treasuries sit on bank balance sheets. Liquidity becomes locked. Capital available to the real economy shrinks. But that is only the first step. When markets no longer have sufficient buyers, the U.S. Treasury has only one way left to sell its debt: offer higher yields. And that is when the spiral begins. Each increase in yields raises the U.S. government's borrowing costs. Small blue diamond, with total public debt now exceeding $34 trillion, a mere 1% increase in average yields raises annual interest expenses by more than $300 billion, a figure larger than the entire defense budget of many developed nations. Not once, but every single year. This figure does not appear in newspaper headlines, but it eats away at the budget from the inside. Rising interest costs larger deficits. Larger deficits, more debt issuance. More issuance, greater need for buyers. A closed loop begins to form. And somewhere along this chain, the Federal Reserve is pulled in. Not because it wants to be, but because the system forces it to. When markets cannot absorb enough debt, the Fed is compelled to intervene, directly or indirectly, to prevent the system from clogging. This has happened before, during crises, during the pandemic, during moments labeled emergencies. But the problem is this: when an emergency state lasts too long, it stops being an exception. It becomes the new normal. And when investors realize that part of government debt is being sustained by monetary intervention, trust begins to erode once again. Not because the system is about to collapse immediately, but because they understand one thing very clearly: when a government must rely on its central bank to finance itself, the line between stability and money printing begins to blur. And it is precisely at that blurred boundary that long-term capital often begins to leave, not in panic, but because it no longer sees a clear endpoint to the spiral. Not every market warning appears in headlines. Most of them are not found in the news, not in official statements, and almost never in evening broadcasts. They live in the details that only those who track capital flows every day tend to notice. The first example, Treasury auctions. Under normal conditions, when the U.S. Treasury issues bonds, demand typically exceeds supply. Investors are willing to buy, sometimes even accepting yields lower than expected. But recently, a phenomenon has begun appearing more frequently. The auction tail. Put simply, the government must pay higher interest than the market anticipated in order to sell the bonds. This is not a crisis, but it is a signal that buyers are demanding a higher risk premium. Next is the bid-to-cover ratio. This metric measures the level of competition in each auction. When it is high, buyers are lining up. When it falls, demand is thinning. And in many recent auctions, bid-to-cover has weakened, not collapsed, but no longer comfortably strong. That is not panic. That is hesitation. Another, less noticed signal lies in the Federal Reserve's reverse repo facility. Previously, funds parked in reverse repo reached into the trillions of dollars, a sign of excess liquidity. Over time, that number has fallen sharply. Money is leaving the safest short-term parking place in the system, not because the economy is stronger, but because liquidity is becoming tighter. When liquidity becomes scarce, even small stresses can be amplified. And there is yet another signal, quieter than all the rest. Primary dealers are holding larger than normal amounts of treasuries on their balance sheets. This is rarely discussed, but when dealers are forced to hold inventory for too long, the system becomes fragile. Because if they cannot distribute those bonds into the secondary market, risk becomes compressed, like pressure building inside a sealed vessel. There is no immediate explosion, only accumulation. And financial markets rarely collapse because of a single large shock. They usually break because many small pressures are compressed at the same time. What is notable is this. None of these signals is large enough on its own to cause panic. But when they appear together, within the same cycle, they tell the same story. That story does not say the system will collapse tomorrow. It simply says that the margin of safety is shrinking. And in finance, when the margin of safety thins, every impact becomes far more dangerous, especially when trust has already begun to crack at a deeper level. What is happening today is not entirely new. Markets have seen a very similar period before, in the mid-1960s. At that time, the United States was still the undisputed financial center of the world. The dollar was the pillar. Gold was fixed at $35 per ounce. On the surface, everything still looked stable, but underneath, an imbalance was quietly forming. The United States was spending heavily on the Vietnam War and on social programs. Budget deficits were rising. Dollars were being printed in excess of the gold the U.S. actually held. Allies began to notice, not through headlines, but through the numbers. In 1965, French President Charles de Gaulle publicly demanded the conversion of dollars into gold, not because France wanted to cause a crisis, but because it was no longer certain that the system could keep its promise. After France came Germany, then Switzerland. They did not dump assets. They did not create a crisis. They did only one very simple thing. They asked for their gold back. Just like today, those requests were initially dismissed as insignificant. U.S. officials reassured the markets. Analysts said the system remained sound. The dollar was still dominant. And for several years, everything did indeed continue to function. Until one day, in August 1971, President Richard Nixon announced the closure of the gold window. The United States stopped converting dollars into gold. The Bretton Woods system ended, not because of a dramatic collapse, but because trust had been eroded for long enough. What is striking is this. There was no massive sell-off immediately beforehand. There were only years of small withdrawals, quiet actions, decisions made just to be safe. In hindsight, many people think the 1971 event was sudden. But for those who were tracking capital flows at the time, it was anything but. It was the inevitable outcome of a long process, one in which more and more creditors began asking the same question. Was the promise behind the world's strongest currency still as secure as it once had been? And that very question is beginning to surface again in today's world. Financial crises rarely begin with a loud explosion. They begin with very small things. One fewer buyer, a slightly weaker auction, a pension fund adjusting its portfolio. Each individual action can be explained away. But when those actions begin to follow one another, they form a dangerous mechanism, a spiral. Everything starts with foreign capital gradually pulling back. When major buyers retreat, the U.S. Treasury must pay higher interest to sell its debt. Yields rise. Rising yields cause interest costs to balloon. Higher interest costs enlarge the budget deficit. A larger deficit forces the government to issue more debt, and that new debt must once again find buyers. Under normal conditions, this is merely a fiscal cycle. But when trust has already begun to weaken, that cycle turns into a spiral. Because each loop does one very important thing. It makes the system increasingly dependent on maintaining confidence. And when a system depends on confidence, even small shocks can be amplified. Rising yields do not affect only the government budget. They spread throughout the entire economy. Mortgage rates rise. Corporate borrowing costs increase. Asset markets come under pressure. As growth slows, political pressure intensifies. And as political pressure intensifies, the temptation to interfere with monetary policy grows stronger. This is the most dangerous point of the spiral. Because when markets begin to believe that the central bank may be forced to act due to fiscal pressure, expectations change. No actual money printing is required. The mere expectation that it could happen is enough. From that moment on, trust is no longer static. It becomes a variable. And when trust becomes a variable, traditional valuation models begin to lose their effectiveness. Investors no longer ask, "What is the yield?" They begin to ask, "How long can this system hold together?" That is a very different question. It has no clear answer, no chart, no Excel model. And because it cannot be answered with numbers, long-term investors often choose the only remaining option: reduce risk. Not panic selling, not a full exit, just small, gradual reductions. But those small reductions, when repeated by many participants at the same time, are precisely what causes the spiral to accelerate. No one wants to trigger a crisis. But in a system built on confidence, once enough people simultaneously try to protect themselves, the outcome is often no longer in the hands of any single individual. What is important to understand is this: what is happening does not imply an immediate crisis. The global financial system is still functioning. The U.S. Treasury market remains the deepest and most liquid in the world. The dollar still holds its central role. But the question capital is now asking has changed. It is no longer, "Is the United States strong enough?" but rather, whether the current level of dependence still makes sense. Therefore, the most likely scenario is not a sudden collapse, but a prolonged adjustment. Some countries may continue to increase their gold allocations, not aggressively, but persistently. Small blue diamond, according to the World Gold Council, global central banks have purchased gold at a record pace for 2 consecutive years, and 43% of surveyed central banks stated that they plan to further increase their gold reserves in the coming year, the highest level ever recorded. Some pension funds may gradually reduce their exposure to U.S. Treasuries, not because of yield, but because new risk limits have been updated within their internal models. Some capital flows may be reallocated back toward domestic markets, where political risk is perceived as more controllable. There will be no joint declaration, no new treaty, no symbolic moment, only individual decisions moving in the same direction. What is worth watching is not how much anyone sells, but who will be next to start asking the same questions. If Germany truly proceeds with gold repatriation, pressure will increase on other countries that store reserves in the United States. Germany and Italy alone currently hold a combined total of approximately $245 billion worth of gold stored in U.S. vaults, a figure large enough that any repatriation move would carry significant symbolic weight. If domestic yields in Japan continue to rise, the incentive to bring capital home will strengthen. If U.S. budget deficits continue to expand in a high-interest rate environment, fiscal pressure will become increasingly difficult to avoid. None of these factors, on their own, creates a crisis. But when they appear simultaneously, they do one very clear thing. They narrow the system's margin of safety. And when the margin of safety shrinks, the tolerance for error becomes much smaller. Financial history rarely ends with dramatic moments. There is no announced doomsday, no global alarm bells ringing. Most major changes in the monetary system unfold far more quietly. They begin when trust, something that cannot be measured numerically, starts to shift. Not because a country weakens, not because a market collapses, but because long-term asset holders begin to reassess how they define risk. What is happening today is not a declaration of the end of the dollar's role, but it is a sign that this role is no longer taken for granted. For more than half a century, the world accepted a very simple premise. The United States might be internally turbulent, but it remained a reliable steward of the global financial infrastructure. When capital begins to question that premise, the system does not collapse immediately, but it begins to change, gradually, quietly, and not easily reversible. Financial systems do not collapse because money runs out. They collapse when no one is fully certain that the promises behind that money will be honored under all circumstances. And it is precisely in the moment when trust becomes a variable that history often turns the page, quietly, but in ways that are very difficult to undo.